Good day, everyone. This is Joseph Trevisani from Worldwide Markets. Thank you all very much for attending. I always take it as a great compliment that people take the time out of their day to listen to what I have to say and to look at the pictures that I conjure up on the screen. We have had a most fascinating time in the currency markets. These are the kind of things that I guess make it worthwhile, certainly make it worthwhile for someone like me who's been around for a while and have seen these things come and go. A couple of notes. If anyone has any comments, questions, jokes especially, please type them in. I will be glad to stop and consider what we have to say and see if I can come up with some answers. This is going to be a very wide-ranging discussion. I prefer it to be a discussion, not just a lecture. The factors involved in this particular event encompass about as much as you can hope for in explaining the way the world currency system works, the way world economies work, the way politics intersect with these things, and not to mention history, of course. For those of you who are relatively new to the currency world, I would say set a date back 15 years for when the euro started trading. This type of event, shocking as it may be, dangerous as it may be, depending, and if you work for FXCM, it's extremely dangerous, is not a new event. And that is why I have this Plaza Accord chart on the screen. It has happened before. And as long as there is competition between a free trading currency system and central banks attempting to control their currencies, their national finances, and, let us not forget, to achieve political and economic ends, this type of event will continue to happen. The goals of a central bank, of a government, are not necessarily, and almost exclusively not, the goals of, or al pari, of currency traders. Our goals are very simple, pure, you might say, in a very loose definition of the term. We're interested in making profits on our positions. How those profits are made and against whom are not of particular importance. Currency markets, raison d'etre. My kids are taking French, so I think I'm learning some. Are not around to determine the proper economic level of any currency. They are not around to facilitate economic development in any particular country. They are not around, they are not intended to aid exports or imports or inflation or deflation or any other economic topic. That's not their purpose. The purpose is to make trading profits for the participants. This is not a goal that leaves anyone outside of the currency markets comfortable, because all of the goals of economics and of politics are quite different. The reason the currency markets exist the way they do is quite simple, because there is no other functional system in our economic world for determining the values of currencies. The world began, sounds like I'm reading something, the world began on currencies in the early 70s after the collapse of the the Bretton Woods system of fixed exchange rates, which had lasted from the 30s. The reason it collapsed is because it could no longer maintain the levels as the changing world economic, as the world grew, as the world economies changed in relation to each other. And that's the same issue we have here. What seemed for the Swiss franc and the Swiss central bank a good idea in September 2011 was no longer a good idea and was no longer even functional 3 years later. What had changed? Well, almost everything. In 2011, the euro is about 1.4. It's now at 1.18. 2011, it looked like the European debt crisis had been handled, or at least it was not going to create any more problems. It is now coming back. And it is very possible it will blow up or at least get everyone's attention again on the 25th when the Greeks have their elections. Many commentators, myself included, have said for a number of years that the issues in Europe with the EMU, which is, I'm going to go through the history of this briefly so you'll understand both where this came from and how it came about, are and will be political. There is no, and I've said this many times over the past several years, the end, if it comes, or the change in the euro will not come about from the finance side, meaning it will not come about from the central banks. It will not come about from any of the currently in power European governance systems. It will come about when the people of the various democracies elect a different outlook, a different government. This may be about to happen in Greece. We don't know. It may possibly happen in France. I was absolutely floored yesterday to note that Marine Le Pen, the leader of the National Front, I believe it's called the National Front, had an op-ed piece in the New York Times talking primarily about immigration and European, if I remember, cultural values, but mostly immigration and assimilation, not specifically about the euro. But both of those politicians and Mr. Tsipras, I think is how you pronounce it, in Greece, have the potential to change the European system. That is the way it will come about. Okay, now let us step back. There's a question up there, I'll answer it. The reason the SNB had to let go of the peg is because it couldn't afford it anymore. It supported the peg by buying euros, a devaluing currency, and it's been buying them for several years. It is not making money on those positions and selling the Swiss franc, and it could no longer afford to do it. Not only couldn't it afford to do it in the current, looking forward, it's my sense that they got some word from Mario Draghi and the ECB that we're moving ahead with our quantitative easing program. In fact, at this point, there's been so much speculation, so much comment from the bank that they can't possibly not do it without creating great dislocation in the markets. We're all going to go back the other way. So they're looking not only at a current situation where they can barely afford to do it, but a future situation. I mean, Switzerland's a relatively small country, and they are gathering in currency assets that they do not control. And the assets were building and building and building. I think I read a figure that they're currently close to 75% of Swiss GDP. So the basic reason, the upfront reason, was they couldn't afford it anymore. And they were looking at a future where the euro is likely to go a good deal lower. At least that's something you have to concern yourself with. If the ECB comes out with $1 trillion of quantitative easing, however they're going to do this, or $1.5 trillion, which I don't think they will, but if they did, and this is something you have to consider, the euro is going to go back to 110. And what does that do to the balance sheets of the Swiss National Bank? So that's the basic reason. Okay, let us continue here. I don't want to make this a history of European monetary and world monetary policy, but back in the 80s, long before I was in the currency, long before I was in the currency markets. I was still driving a cab in New York. Actually, I was still in college, and then I was driving a cab in New York. The first and very successful. Now, there's something to be said about currency interventions and central banks. Central banks, as we've seen for the past couple of years, I mean, the past couple of years that we've been trading nothing really but central bank policy. You always, in a sense, trade central bank policy because even when you trade economic statistics, what you're trading, in fact, is their effect on long-term currency policy from the central bank. If the market's getting, if economy is getting stronger, if inflation is rising, if employment is becoming tight, then you're looking at some point in the future, a rising rate cycle from the central bank. That's the essence of currency trading as far as the long-term trends go. So in essence, you're always trading central bank rate policy. But you are trading it historically based on a remove from the economy. Now, we are all trading on strict policy. For the past 3 years in the United States, past 4 years, what is the central bank doing? What is the Fed doing? They're starting up with QE. Are they going to do more QE? Are they going to surprise everybody? As in yesterday or last week with the Swiss National Bank. So you're directly trading non-interest rate policy, although in fact, many of these things are actually interest rate policies to begin with. But back to history. This is a chart, and we're looking at the early 80s here, back right here, 1985. The Plaza Accord is very successful. Its purpose was to devalue the U.S. dollar. Back in those days, and I can't say that I remember them, but I have read about them, the idea of a U.S. deficit, trade deficit, was shocking. The idea that U.S. Manufacturers were becoming uncompetitive was shocking. The U.S. had dominated world exports, the world economy, since the Second World War, and for obvious reasons. Its main competitors were all destroyed during the war, or severely damaged during the war. England, France, Germany, Japan, can't quite say Russia, were all heavily damaged during the war. The United States was not. So we dominated the world economically at that point, all of which began to change. There was a great deal of pressure in the United States to devalue the dollar. They were talking very incessantly about the damage this is doing to the United States economy. So this chart here, I have various currencies up here. These charts are all Bloomberg. Those were the days, of course, before the euro. So if you look at this is, as I said, we'll do this again in 92, but it's not nearly as dramatic in 92 as it was in the Plaza Accord, which is why I want to illustrate central banks can be successful manipulating the markets. It's a perfect example. What they did here, and when they're successful, what they do is they abet what the currency markets want to do anyway. The Swiss National Bank was attempting to prevent what the currency markets wanted to do. But here, you can see that that was not the case. The currencies, the dollar's value against many of these currencies. We also have sterling on here. Remember, sterling's opposite because it's quoted on the other side. All the other ones are quoted dollar terms. The currencies had already, but let's step back a bit. So there was a great deal of pressure in the United States. I think Ronald Reagan was president. I'm pretending to say I think, but Ronald Reagan was definitely president, 80 through 88. And the U.S. government, along with the governments of France, Germany, England, and Japan, formulated the Plaza Accord to lower the value of the U.S. dollar. But what you can see that had been happening already was that the markets were already beginning to understand that U.S. competitiveness was changing, that U.S. domination of the world economy was changing. The rest of the world was catching up. So the pinnacle that the dollar had been on since the Second World War, certainly since 73, even since the collapse of Bretton Woods, was slipping. The markets had already noted this. And so when the Plaza Accord came through, now, there's another reason behind this which we mustn't forget. This tremendous rise. Look at all these currencies. That's the French franc. You guys, most of you probably have never seen a French franc. I think I have some at home. My kids go through, I have this jar of all this currency that I've gathered from around the world from all my trips over the past number of years. And the girls are fascinated by it because they all these, there's 6. All these currencies represent another country. They represent someplace else. So it gives them something tangible to think about. They look at a yuan and they start thinking about China. Anyway, so most of you have probably never seen all these currencies, but I've got them all at home. I don't think they're worth anything. And you can't turn them in anymore. But you look at all these currencies. That's the French franc, the cable going down, the dollar rising. The yellow is the Deutschmark, the German Deutschmark. The green is the Deutschmark. The yellow is the DXY. That's the dollar index. From the 80s, the early 80s, they all start shooting up. What happened? It's not a question and answer period, I'll tell you. Paul Volcker raised U.S. interest rates to somewhere around 15 or 16% to squeeze out inflation and stagflation from the U.S. economy. Paul Volcker was appointed by Jimmy Carter and fully backed in his monetary policies by Reagan and given a great deal of political cover by Ronald Reagan, because if he had not, there would have been screaming and yelling all through Congress and everywhere else about what's happening. And so this, of course, caused the dollar to shoot up. So from a central bank point of view, the rise in the dollar was artificial. It was determined by the U.S. interest rate policy. But as we all know from trading, once a currency gets to a particular level, it doesn't necessarily move back to some other value because the logic is not there. It needs a market force to push it down or to push it up. The yen is a great example of this. The yen is, where's the dollar? The yen here is the white line here. Through this period here, with the yen at down to about 85. Good example. Did the low interest rates in Japan, 0 rates forever, the moribund economy do anything to damage the value of the yen? No. Nothing moved the yen until the Japanese central bank and the prime minister came in and changed the policy. So you need an active force to get the currency markets to move. That is what the Plaza Accord envisioned, and it was very effective. It was designed to lower the value of the dollar, and that has continued. Look at this. We've got a nice slope from here all the way down to here. And we've got a bit of a change here lately. So central banks can be very effective in what they're doing, especially, and this is the key, when they are coordinated. 2 factors are necessary for central bank effects, in my opinion. 1, coordination, but 2, even more importantly, they recognize an inefficiency, if you will, in the currency markets that they know the currency markets will be convinced of once they're changed, once it's pointed out to them and they start moving. That is the case we saw here. They were not attempting to enforce a rate band. They were not attempting to enforce fixed rates. The other examples that I'm going to show you in a second were, as in the SNB recently, attempting to support fixed rates. And they were doing it alone. So here's the Plaza Accord, the probably chief example of an effective central bank manipulation of the currency markets. And of course, there's another factor behind this. While this was going on, inflation was defeated in the United States and rates started coming back down. So really, it's my opinion, my guess, that much of this decline in the dollar would have happened anyway because U.S. rates were coming down. It might not have happened as quickly. It might not have given the politicians a chance, especially American politicians, to say they'd done something, but it would have probably happened anyway. The markets clearly had already started to move 6 months, 9 months before the Plaza Accord took place to move the markets. So you might say that all the governments and the central banks are taking credit for something which would have happened anyway. Be it as it may, it doesn't matter. It was certainly effective. It certainly speeded the move and put the great prestige and weight of the central banks behind the move. Okay, so that's the Plaza Accord, an example of successful central bank intervention in the currency markets. Now let's look at the most famous one there is. This is the origin of George Soros's, that's not the origin. He made a lot more money than this and still has. But it is the famous Black Wednesday, as it's called, when the British government, Major's government, I believe, Norman Lamont was Secretary of the Exchequer, I believe. I know I mentioned Nigel Lawson in my write-up on, you probably didn't see that was right up on my Facebook page, but it was an attempt at humor, so we'll see if that worked. Apparently not. Anyway, the history of this particular event is tied up with European history. It's actually tied up, if you will, with the Second World War and the history of the European continent and the world, if you will, in the 20th century. And the reason I say that is because it is tied directly to the common market, what used to be called the Coal and Steel Pact originally, to the desire of European governments and European populations to avoid another century like the 20th, at least the first 50 years of the 20th century. The common market, the European Union, have a political basis, not a financial basis. Not, if you will, an organic growth basis, although, of course, there's some of that. It's really only determined by proximity rather than by design. The goal of the European Union was always a political and economic entity. It was not always discussed in the open. It was not always, but it was always there if you wanted to see it. The steps along that way led to the creation of what was called the European rate mechanism, actually the European monetary system, then the European rate mechanism, which was envisioned as a precursor to the euro, to a unified currency, which we now have. What was done was the bands were established. Does this starting to sound familiar? Bands were established within which the currencies could trade. They were essentially pegged to the strongest currency in Europe, and we all know what that was, the German Deutschmark. Various countries, all of the countries in, remember there were lots of countries, lots of different currencies then, you know, the Belgian francs and the Swiss franc, the French franc, and all sorts of others. The German Deutschmark were the biggest ones. The central banks were required under this arrangement to defend the trading bands. If nothing changes in the world, as with the Swiss franc and European economic history from 2011 until now, then the bands are fine. But of course, that's not what happened. As this was designed, but not quite implemented, the Soviet Union collapsed. Germany became reunited. West Germany, as it used to be called, and all those great spy novels from the 50s, especially John le Carré, and many others about the permanent Cold War, which, again, I remember some of that. I remember a good deal of it, actually. Why be cute? But the political determination, as we're seeing now with the euro, it's harder to track, but the long-term trends are based on politics and the changes required and demanded by the populations of the democracies of Western Europe. Germany reunited after the Soviet Union collapsed. Germany was spending enormous amounts of money supporting, I forget one of the figures, let's see if I have it here. I don't know, 50% of GDP, some enormous amount of money supporting East Germany. Because East Germany was much, much, much poorer than West Germany. Well, Germany began to worry about inflation. German rates became far too high. Does this sound familiar? What we're seeing in the ERM is being played out right now. It is no different. German economic needs, German fear of inflation, German deficit spending to support what's going on in the former East Germany, mandated higher rates. The other economies, France, Italy, Belgium, Spain, couldn't, although I think Spain was not in the ERM. No, probably it was. And also, yes, it was. Excuse me, it was, and so was Portugal. German rates made the Deutschmark much stronger. But the central banks of all of the countries in the ERM were required, including Britain, were required to maintain their currencies within a very narrow band by intervention. And when intervention doesn't work, by interest rate manipulation. And it became quickly evident that they could not. At one point, Britain was forced to raise its rates, and this was the only first time in Britain, but then happened in many other places, in order to defend the band, the trading band. It was intervening in the markets, buying billions and billions of Deutschmarks, the mark sterling, or sterling mark, remember it very well, trading these currencies. I was actually sitting on trading desks when this happened. I had just joined the market a year earlier. I didn't quite really understand what was going on, but I remember watching the mayhem. Because remember, in those days, it wasn't just the euro and the Swiss franc and the sterling and the yen. There were more than a dozen currencies in Europe, and we traded on the Credit Suisse trading desk, every one of them, and so because we're a European bank, and everybody was responsible for it. And the markets are going bananas. You got all these people in the trading room screaming and yelling, trying to get prices, trying to cover the Belgian French franc cross. When the French are raising their interest rates to 20% or whatever it was, and the Belgians doing this, and it just was complete mayhem. The attempt to defend these trading bans failed. It failed first in Britain on that famous day. They still, I think, probably quail at it at the Bank of England. Institutional memory is fascinating, and all of these institutions remember this stuff. And they had to drop out of the ERM. They gave up the band. And look what happened to the sterling. This is a week. Sorry. Oops. Let me just end this one and get it up again. Sorry about that. There we go. This is a weekly chart because that's the only I could get going back far. But you can see what happened. from 2 down to 1.4 in about 3 months. In an attempt to defend its band, the British raised interest rates to 15 to 12%, if I remember, and then threatened to raise them to 15. What do you think it does? What does it do to an economy to put your rates at 15%? Well, we already know from the United States because Volcker did it in the early 80s. It sends you into a very, very deep and painful recession. So even though the British were threatening the markets directly, because what happens if you have 15%, you roll that position overnight, you've got to pay very high charges on the roll. That's the purpose of that. They were aiming directly at George Soros and the rest of the currency speculators. Of course, we're all speculators. That's the point of this. Most traders are speculating in one time point or another. That's what we do. That's what markets do. That's what they're designed to do. The idea that this is some sort of not respectable, if you will, endeavor is silly, certainly as relating to the financial markets, certainly in the modern world. But the markets knew. We all knew. The traders knew. Everybody knew. Britain could not sustain 15% interest rates on their economy without tanking the economy and sending it into a painful and deep recession. So you just wait it out. And that's what everybody did. Britain was forced, September 16th, 1992, to withdraw from the ERM. And like dominoes, they all began to fall. Italy, the French franc, the peseta, the escudo, they all dropped out of the ERM, and the ERM essentially collapsed. And it collapsed for a very similar reason as to why the euro is having problems now, because very different economies are tied to Germany. And Germany is a much different economy than the rest of the EMU. Okay, so that first attempt, and at that time, of course, all of the national currencies were still around. So whoever wanted to could return, and they all did, essentially return, to the free-floating currencies that they had before. So there was not a great dislocation involved in doing that. In fact, it was a great benefit because at that point, all of the currencies devalued, which of course helped exports, helped tourism, brought them back to the way they had been doing business before. The European system was always designed to function and to create a single currency. I think its purpose is actually to create a single country, but I don't see that having any reality whatsoever. It's having enough trouble with the financials, forget about the culture. So the next step, taken by, in 1992, at the end of 1992, the Europeans signed the Maastricht Treaty, which created the euro. So this experience with the power of the of the currency markets, of the general market, and the inability to control it did not deter the Europeans one whit. They went ahead and created the euro. And not only did it not deter them from creating the euro, they created the euro with many of the same faults that the ERM attempted. The only difference is, and it's a big difference, the fallback has been cut away. It was very easy in 1992 to give up the trading band and revert to a devalued currency in a sister economy. It is now very difficult to do that. And in fact, it will be a very brave Greece that attempts it, if it does, or any of the other countries. I'm not saying it's impossible, but it is much, much more difficult. And I think that was the sort of the intellectual background of the euro. It's easy and tempting to look at the designers of these systems and say, how could they have done this? It makes no sense. Can't they see? But in fact, they can see. And most of these people are, I don't know any of them personally, at least very few of them, are very smart. And they do understand the things that are possible and where it's likely to go. But there is no ideal system. There is no ideal construct for what they are trying to achieve. All of the choices are imperfect. But when they tie them to the goal, which I think is still there, of European unity, the hope, combined with the lack of alternatives, drives the system to the euro, despite its myriad imperfections. Okay, we are now a little more than 20 years later, and we have almost the same situation. So I want to think about where I want to start with this. Let us start with Euro Swiss. Okay? This is a chart of the Euro Swiss and various other currencies in the run-up from 2011. The basic setup in 2011 back here. Okay, where's the Swiss? The Swiss is the yellow. Okay? Here's the Swiss. The dollar Swiss. Okay? What happened in the run-up to 2011 and the imposition of the Swiss, Euro Swiss floor by the SNB? Again, like the collapse of the ERM under essentially the flail of German unification, a political change, a real change in the world. That is what drove, I'll answer that in a minute, but let me get through this point here. That is what drove the collapse of the ERM. The world changed. The concept of the ERM and ban trading is, of course, antithetical to the idea of free-floating markets. The reason free-floating currencies are permitted is because it's the only thing that works. It's not because central banks and governments love free-floating currencies. It's the only thing that works. It's the only method, as vastly imperfect as it is, for determining international currency rates. You can't have a bunch of economists and academics sitting someplace and say, well, this rate should be this. It doesn't make any sense. Can't do it. Markets function because they are the best alternative. Everything else is theoretical. The changes in the world from 2008 to 2011 are what determined the Swiss bank Swiss National Bank to attempt what's essentially an updated ERM with one currency, putting the floor in the Euro Swiss at 120. And what was it? It was this appreciation here. When I was trading back in the 80s, not the 80s, but in the 90s, the Swiss franc was, the dollar Swiss was trading 1.4, 1.5, sometimes 1.6, 1.2 is usually the bottom. By 2011, it was down at 0.74. You know what's interesting? Take a look at this. The dollar Swiss here, right? Back in 2011, with a free market, the market determined that the Swiss was someplace around here, which is about 7.3, I think, 7.2. Where did it go when it was trading? It went down to 7.4. The equivalence between those two rates, or the very similar rates, is not coincidence, of course. This is where the market wanted it to be. But okay, back to the story. So, because of all of the events in the world, the world financial crisis, the incredible flight to quality in 2008 and 2009 for financial assets. Where'd they go? The dollar? The Swiss? In the yen. It drove the Swiss franc to historic highs. It wasn't so much because the Swiss had high interest rates. It wasn't because the Swiss economy was booming, although it was doing well, and very low unemployment. It's because people demanded and wanted Swiss assets because it was perceived as safety. Well, that may be good for the Swiss financial system. It's rough on the Swiss economy. It's rough. You know, the price of Rolex watches goes up 40%, makes it tougher to sell Rolex watches. Swiss chocolate, whatever this is a Swiss export. And I think I read someplace that watches are 10% of Swiss exports. That's pretty phenomenal when you consider that watches are kind of small little things that not many people own, at least not the fancy ones. Anyway, I actually have I am currently wearing, I have some watches, a very old Swiss Omega from the 1930s. So anyway, there is a market for that. I just throw that in there. So the basic problem that drove the Swiss to put a floor in were political and economic. They were not under the control of the Swiss government. But the Swiss calculation at the time was that we can do this because one of the great drivers was the European debt crisis, which blew up in the beginning of 2010 when the Greeks said, nope, our budget deficit is not 3%, it's actually 13%. Whoa, pretty big change. And certainly got everybody's attention. By that time, it appeared that the Europeans had handled the crisis. At least it was no longer escalating. The European economies were recovering. They weren't doing great, but they were recovering. Inflation was running 2%, maybe a little bit more. The macroeconomic picture looked recovered. And so based on that assessment, the Swiss operating by themselves, the Swiss National Bank. Remember, the euro was at 1.4 then. Would we have the euro on here? We do. The euro is the green here, 2011. The euro is right up here, right? And that's a big recovery from where it was in 2008, of course, when everybody was buying the dollar and terrified that the world was going to end. The world usually doesn't end. Every once in a while it does. But since we're still here, I guess it doesn't. It's not very funny. Let me just answer this question. How does it affect the euro Swiss in the long term? The Swiss in the long term? I think as long as there is concern for the world economy, the Swiss franc, let's put it this way. I think the Swiss franc has become, even more so than before, a safe haven. And Swiss assets have become a safe haven currency. It's not even that you're holding Swiss francs, but if you want to keep your assets, some of them in Switzerland, then it seems like a pretty good idea to keep some of them in the Swiss franc. And so that is what's driving the issue for the Swiss National Bank. So for this period here, all this period here, the Swiss managed this band, which essentially is what it is, but a floor, quite well. They could afford to do it. The euro went down, but then the euro went back up. And so they could afford to intervene when necessary in the currency markets, and they were there on the bid. They were buying the currencies. But what happened recently, since the middle of last year? The euro tanked. That's the technical term. It went from 140 down to 120, and then it even went lower. And it's probably going to go lower yet. What else is going on? The European economies are stuttering, to say the least. Some of them are back in recession. What else is happening? Europe is in deflation and terrified of it. At least the central bank is. The European Central Bank has been trying. If you think the Fed has problems with controlling fiscal policy, it's nothing to what the Europeans have. The European Union, the European Money Union, is 18 members and 18 central banks and 18 economic policies and 18 governments. The only unified actor in the European system is the European Central Bank. But as in the ERM, the policy, economic interest rate that works for Germany does not work for the rest of the ERM. In this case, it's the EMU, but it's the same thing. So as those changes began to work through the system, began to work through the markets, the pressure on the Swiss franc escalated. The Swiss bank was spending more and more money. I think they're up to 75% of GDP. In acquiring devaluing assets. They're buying euros as the euro is going down and going down and going down. The Swiss National Bank is not like the Fed. The Fed owns the world's reserve currency. Gives them enormous leeway. When people buy our debt, we pay them off in dollars. When you buy Swiss euro debt or Swiss franc debt, that gets changed back into currencies on the other side. So the pressures on the Swiss bank were much different and much harder to abate. So eventually, as in last Thursday, and it is fascinating that 3 days before, I've heard reports of 3 days before and 2 days before. One of the Swiss bank governors, I believe, was out there saying the peg is an essential part of our monetary policy. Well, essential till it's not. So the Swiss simply decided that not only can't they support it now, but they can't support it in the future. Now, it's debatable as to where the Swiss thought the Swiss franc would go when they let go of the peg. It's my mind they should have known very well where it would go. It would go to where it had been before they put in the peg, or some approximation of that, which of course is what happened. Now let's look at the mechanics of what happened. Let me just answer this question. What do I want to put up here? The Euro Swiss is what moved. Okay, so let's take a look at this first. I'm going to drill down from the upper level to the lower level, right down to some prices. I actually have some prices so you can see what was actually going on. It's absolutely fascinating. And it's why we've had some of the problems with FXCM and Alpari. I'll explain why. I'm going to have to move a little bit here because we're getting on. I'd like to ask FX Street, do we have ability to run over a little bit today? Or do we need to keep strictly to our hour? No, I don't think that. What I think will happen is that the Germans will. You know what? I don't quite have an answer for that one. No, I don't think the Germans will bring back the mark. What I think would happen, and I think will happen, is that the euro will cease to be the currency for everybody in the ERM right now. I think some of the because the Germans, there's no reason to. The euro is essentially the mark. So the policy in the European Union is mostly the policy of the German central bank. Now that may change right now, and we'll see how it goes with the quantitative easing and how that goes. Okay, but back to this. So at 4:30, New York time. Thomas Jordan, who must have been very red-faced, said, we are no longer supporting the Euro Swiss floor at 120. This is a half-hour chart. I was asleep. Nobody called me from the trading desk. I'm not on the trading desk anymore. I'm on the research side. But this is something that would have given me quite a call. Okay, so this is the move. This is half an hour. It's a half-hour chart. When the Euro Swiss went from 120 to 85, a little bit north of 85. Okay, let's take a look at what happened. Let me go back to this chart. Now, to explain how some of this transpired. The prices in the system that you see on our system and all the other systems, they have an origin. They don't just get pulled down from the ether. There isn't some great market on Mount Olympus sending out prices, so we all know. The prices, of course, come from the EBS and Reuters systems, which are interbank trading systems. They are submitted by traders. Behind those prices are people sitting on trading desks, like I used to do, putting in prices where they want to get deals done. Most of the time, in an orderly market, there are many, many prices. They're very deep. Lots of deals get done. The markets move in an orderly fashion. When something like this happens, nobody has any idea where the market is. I've seen situations like this. I absolutely have. When the ERM fell apart, I was sitting there on a trading desk in the Asian shift, running the Tokyo shift, and we were running orders in the French franc, Belgian franc cross. We had a huge stop loss order. None of us on the trading desk had any, because somebody had just left the ERM. None of us had any idea where this was. And we had like a 50 million franc position because a customer left an order and we had to execute the order. That's what was going on the trading desks. The traders were not making prices in Euro Swiss for the market. They were attempting not to drown from all their orders. The way this moved, it's clear that there were orders executed. What happens on a bank trading desk is you look at your order book, and as this is going down, you probably had quite a few orders at 1.15 stop loss orders. That means the customer is selling to you. So as this is crashing, you're acquiring a long position in the Euro Swiss. Not for the faint of heart, believe me. I don't know how large these orders were. I know that some of the reported losses, $150 million here on trading desks, tell me that there are a lot of positions. But on the other hand, this move is 35 figures. 120 to 85 is 35 big figures, 3,500 points. If you have I'll do that in a minute because I'm going to run out of time. I don't want to do that. But believe me, it's a great deal. I would calculate what this would cost you if you had a one-figure move in 100,000 in the Swiss, okay? Times 0.01. Just want you to realize how much is going on. Then you have a $10,000 loss on a $100,000 position. So it goes on and on and on. Okay. When this is happening, all of these orders are being accumulated. But this is what the price action looked like. Okay, that's a 30-minute chart. It's astonishing in its move. But this, in the Euro Swiss, is a tick chart. Now, the way tick charts work, when they're displayed like this, many more prices go through than what you're seeing here, and the system actually picks prices representative of the move. So this isn't a complete record of the Swiss price, of the Euro Swiss prices, but look at the moves here. At 429, wait a minute, let me see if I've got the other one. Okay, that's not it. We'll have to go with this one. Just want to make sure we have the right one here. Oh, I know what. Let's do it in the Swiss. Well, let's show the Euro Swiss first. Anyway, this is the tick prices in the Euro Swiss. At 429, before the news comes out, 120. At 4:33, 4 minutes later, already 19 figures down. And on and on and on. So you can see how rapidly this took place. The losses that you hear about were because not only couldn't you get out of these positions, because there were no prices, and I'm going to show you an example of that in a second, but because it never came back. If you're long here, if you're long here and here and here and here, the best you can do if you didn't die or have a heart attack when it went down to here, and you probably don't. I've sat through moves like this. They almost always come back. Almost always come back. Came back about halfway. So you could get out here. There's no other way to get out. And that's what some of this. In here, there's actual dealing. In here, there's sheer panic. So the losses that you hear about in trading desks are because these positions could not be cleared. Okay. This is an actual, oops, wrong one, hang on. This is an actual price record for 1 minute. 1 minute from Bloomberg's all system, meaning all their prices. Okay? This, we start out at right at 4:30 here. There are, on that 1 second, well, let's look at the next one. Look how many prices go through on 1 second. This is 4:30.59. It's 4:30.59 over here. And in that one, I find this hard to believe myself, to tell you the truth, but computers are wonderful. In that 1 second, 4:30.59, the price is, this is astonishing, from 17 to 15. Two big figures in 1 second. I'm astonished, and I've looked at these before, so I knew this. I knew what this record was. But that is what you are looking at in this type of move. So all of these prices go through. I'm not even going to count them for you, but they look to be at least 30 prices going through in 1 second. Not one of those prices could anybody deal on. Impossible. Now, I'm not sure how Bloomberg generates these prices. Oftentimes, Euro Swiss prices and cross prices are generated from the underlying. So this doesn't mean that there are say 35 actual prices available for dealing. This is calculated. Let's take another look. Let's take a look at the Swiss. Okay, this is the Swiss. 30 minutes. We have the same issue. I will show you. This is a similar chart in the Swiss with the minute laid out. So 429, the Swiss read from 102 to 94. 433. There are other prices within here. Again, this is the way they have to display these prices. 433, it went from 946 to 902, 6 big figures in 1 minute, and then back up again. None of these prices were dealable. Let's take a look at this. That's the one we just showed you. Hold on. Okay, sorry. Hold on 1 second. Okay, this is a similar example in the Swiss. Okay, so as these prices are going through, no dealing is happening. Now, I think a question for all of us that I'll deal with, and then I'll have to end on this and just do a recap as for what I think the future is going to hold on all these things. So we can see that the background on this. Let me deal with the case of FXCM to begin with. I'm not privy to FXCM's internal information or internal books. I know what I think happened, and I will tell you. If FXCM was STPing all of their trades, that means straight through processing. That means that they didn't hold any of their trades on their books. How could they have gotten into so much trouble? If they don't have a position, how can they have such huge losses? This is what happened, at least in my estimation. And, currency trading is a relatively simple business, so I think it's probably accurate. And I wouldn't tell you if I didn't think it was accurate. Straight through processing means the trades go somewhere else. But it also means that it's a hedge and not a book. If you're a stockbroker, right, and you sell somebody, you simply sell somebody a stock, you simply act as a middleman. What I think happened with FXCM is that the positions are still in some fashion on their books. They are simply hedged against an outside entity. So if you sell a million euro to FXCM, it's on their books, but then they go and sell €1 million with someone else. So the position's hedged. But when a market so there are two positions involved here. There's the customer position on the book, and there's the hedge position against it. When the markets move like this, it doesn't really matter how fast your computers are. You cannot close the position of the customer at the margin limit because there simply are no prices to deal on. So if your margin limit in the Swiss, you start at 120, it's 120, 1.02. If your margin in the Swiss, let's go back here, take a look at the prices. If you start out here, say you're a particular customer, or say your overall book, just in theory, is margin limit at 94.96. Just for an example. That's where the customer runs out of margin. You should cut the position. But because of the nature of the pricing, you can't cut the position till 83.76. Well, the customer book doesn't have any more margin. Now, on the other side of that is your position with whoever you're hedging with, Goldman or whoever's on the other side of the trade. They also have a position, which you can't get out of with them. So if FXCM, and again, this is theory. I don't have any inside information from FXCM, although I do know some of the people over there. And there has to be a lot of sadness over there because that was whatever you want to say about FXCM and their business. They were the leading largest, and they had a very viable business, and their stock was 17. I think it's about $1 now. Somebody lost a great deal of money over there. Probably the owners. Anyway, so not only is your margin position on your books cut out well beyond the margin limit, but you can't close your own position with your counterparty. And that's where the disparity in loss, that's where the $225 million comes in. If FXCM had the full amount in their account that the positions were closed at, then they would have a loss and a gain balancing with their position at their counterparties. They did not. I don't know where the position with the counterparties were closed, but probably the way the dealing took place, probably in a similar place as to where their own computer system closed out the long positions in the Swiss and the Euro Swiss. But because the house positions from the customers were closed out so far beyond margin, they do not have at FXCM the equity that they should have. They didn't make what they owe in losses to their hedge positions. And that's where the problem with FXCM, I think, came from. I don't know where Alpari's issue is. My guess is it's similar, but I don't really know. As far as the New Zealand broker that went under, I don't know anything about them. I wasn't even aware that they existed, to tell you the truth. Most firms didn't have this problem. We didn't have any problems. FXDD, Forex.com, we have a different business model. We don't straight through. So as you can tell, with proper risk management, the comparison between the systems is pretty evident as far as the market goes. Okay, so that's the specifics on what I think happened with FXCM. Now, let us go back once more to the overall picture here. And then we will end. I know we're running over. I thank everyone for staying. I've always been complemented by that fact. The Europeans, if they did not give up the euro and the plans for the euro after the ERM debacle, they're not going to give it up now. And they will do whatever it takes, in Mr. Draghi's word, to defend this particular setup. There are two reasons. One, it is and has been the goal of the European political and financial elites for 40 years, really longer, since the Second World War. And two, there isn't a viable alternative. There is no sense, and I get there is no sense, of Europe returning to 15 or 18 or 25 different currencies. I don't think that, except for very small countries that have joined the euro, I don't think there is going to be any great movement at any time in the next 10 or 15 years for much larger countries, Poland, Hungary, Romania, which are EU members, to join the euro. I also don't think there'll be any pressure from the EU for these countries to join. Whether or not the Greeks, the Italians, and others leave the euro, I don't actually have an answer for it, but I have speculation on it. It depends on how hard the Greeks, for the moment right now, being the ones in the spotlight, push. Well, one, will they elect Caesar? Will the government be under the control of a party and a political system and a mandate, to some degree, from the population to change the economic structures vis-a-vis their membership in the euro and perhaps their membership in the EU? It becomes a negotiation. And if the negotiation is successful to some degree, if the Greeks get relief, and I think they will, then the rest of the EU, of the EMU, especially the Italians, the Spanish, and the Portuguese, will take this as a cue that this is also necessary for them. The structure of the euro will, I think, change. It cannot be that Germany dictates financial policy for the entire continent. For a very simple reason, it doesn't work. And it doesn't work not simply because of the Greek debt system. Yes, I think that's absolutely true. This one is very difficult to tell how it's going to play out. It is quite possible that the opinions within the German government, within the Bundesbank, are similar, although they're not going to say so, to the opinions in some of the countries that are suffering under this particular system. In Greece, in Italy, France, perhaps Spain and Portugal. That the system as engineered doesn't work. Remember, when the EMU started, the hope of the designers I'll answer that in a second. The hope, the expectation of the designers of the system was that the unified currency would force congruence amongst the systems, the economic cultures, if you will, of the various countries. In other words, everyone basically would become a little more German. that really hasn't happened. And I don't think it's going to. And I think it was foolish and perhaps optimistic, shall we say, pie in the sky, to expect that given the history and given what the European Union was designed to avoid, which is a history of the Second World War, that suddenly, because you put in a single currency, everybody's going to become one. It certainly didn't work under the unified Soviet system. Poles remained Poles, Hungarians remained Hungarians, and the overlordship from Moscow was not particularly loved. I think you have a similar problem here. So it's very difficult to say how the system will evolve, but evolve it must. All right, let me answer this question here. Well, you know, that's true. And I think also what's going on is that gold, if you've noticed, nobody been paying much. Gold is sort of flying under the radar these days, but gold is considerably stronger over the past several weeks, past several months than it was before. And that is primarily due to concerns about all of this stuff. As far as a red flag, yes, the joke's good. I'm not sure we're gonna see anything about that. The future construct of the European Union and of the euro is going to change. And I think the Swiss are acknowledging this by taking their money and going home. Meaning they are not going to spend any more money supporting a currency peg that they can no longer control. Okay, folks, I think we probably should end here. We've run about 15 minutes over. I thank you all very much for attending. I hope this was some sort of elucidation, fancy word, for what's been going on. And specifically what I wanted to do was to illustrate what actually happens in the currency markets when these types of moves takes place, and why, if you're trading, you can't get any prices, because there are no prices. And why the moves are so rapid, because nobody actually knows what's going on. Okay, I will put my email address up there. If anyone has any discussions or comments, criticisms, or jokes they'd like to send me, I will be glad to attend to them, and I'll send you all the answers. I do have an answer that I'm owed to from the last webinar, which I will say. For you people who come to my webinars fairly regularly, I will do, the next webinar is on the one that was the topic, the technical topic, that was superseded by the Swiss, but that is the next one scheduled for FX Street and worldwide markets. Again, I thank you all very much for attending. As I said earlier, I am complimented that you all take time out of your day to listen to what I have to say, and I hope you all have a very good day and enjoy, whether it's morning, noon, or evening. Take care.